We're back on Morning Trade Live. Let's focus on tech hardware stocks today. Morgan Stanley bullish on the memory sector and as a result issuing downgrades for Dell, HP and HP Enterprise. All three stocks are down on the call, as you can see here, in the vicinity between 3 and 7% right now. So that is the focus of the morning trade. Joining us now for a closer look is Schwab Network host Marley Kayden. Very good morning to you. Happy Monday, Marley. So what went into this call by Morgan Stanley on these hardware names? Talk us through the note.
Good morning to you, Sam. Yes, like you mentioned, it's really a bullish outlook on the memory names, and then in turn, creates some headwinds for these hardware names. We are seeing them under pressure today on the heels of these downgrades, a double downgrade for Dell. That's why we're seeing them down the most. So Morgan Stanley put out this note saying that the rising memory costs and the weakening non-AI hardware demand have prompted them to cut those ratings on the hardware makers, making them more bullish in the memory segment. They're citing mounting margin pressures across the sector because the current backdrop right now is what they're calling a memory super cycle, with these NAND and DRAM spot prices up anywhere between 50 and 300% in the past 6 months. That sharp acceleration in component inflation will likely weigh on the earnings for these hardware companies in 2026. So that's where we're seeing some of these margin concerns. They're saying that typically hardware OEMs historically face gross margin compression about 6 to 12 months after we start to see these memory costs start rising. So now they're expecting that to hit in 2026 versus the Wall Street forecast that originally called for slight expansion. Dell and HP came in near the top of Morgan Stanley's most vulnerable list as being two of the most exposed companies in the spike of these DRAM and NAND prices because of their high reliance on memory-intensive PC and server products. HPE also has some headwinds tied to integration challenges and rising component costs, but Dell and HP were of more concern to Morgan Stanley. So let's walk through each of the downgrades. Dell got a double downgrade. Like I said, they're down more than 7%. Price target went down to $110 from $144. They cited that increased memory cost, a mix shift to AI servers, which will in turn turn to lower margins. They said, quote, Dell is one of the hardest hit stocks from rising memory costs. They also reduced their fiscal 2027 gross margin forecast as well, thinking that this super cycle will hit them into 27 as well as 26. For HP, they went to underweight from equal weight, dropping their price target down $2 to $24, down from $26. Same citing there, this PC refresh cycle could be a potential benefit to them, but those higher prices will compress their margins. And then for HPE, they went from equal weight to from overweight to equal weight, price target down $3 to $25, saying that they do still view the acquisition of Juniper Networks as a positive, but those rising component costs will limit profitability there. So we are seeing these names under pressure, where we are seeing the memory names like Micron getting an upgrade today, SanDisk, some of these other companies on the move higher on these moves, but the hardware names under pressure today, Sam.
Yeah, it's memory versus hardware. It's interesting that the street has caught up with some of these trends, because it was about 2 weeks ago where there were reports coming out of south of China talking about how these wholesale electronics markets had seen the rise in memory products, which was going to translate into higher consumer electronics products. So it's been a very interesting trend, and we're starting to see this sort of play out in the pricing in the markets right now off the back of these analyst notes. Thank you so much, Marley, for that. I'll talk to you a bit later on, as always. Let's trade it now with Charles Moon, stock strategist, Prosper Trading Academy. How are you approaching your example trade, Charles, for Dell?
Yeah, with earnings coming up, I'm certainly looking for some sort of positive catalyst. Usually when stocks have this type of retracement, this short period of time off of their highs, it changes kind of the valuation aspect leading into earnings. So I feel that it's still, offering up some short-term value. Anything that's going to be related as positive from earnings could lead to a nice little boost in the stock. Now, in terms of earnings performance, it hasn't been great over the last 4 quarters, but overall, I do like the value in this opportunity. I'm looking at the November 28th, 125, 133 call vertical spread for around $3, maybe a little bit up above $3 or lower if possible. But ultimately, buying that 125 and shorting the 133 allows us to kind of capture that projected implied move. We could see it really race up to 140 off of earnings, maybe even as high as 143 in the near term. And more importantly, the overall risk values of the spread isn't that expensive. I would actually be risking the price of the spread right around that $3. But I believe that if it could make that jump to 140, 145, it'll be well worth it. And again, with the suppression in price, especially this 25% retracement in just the last few weeks, it offers up short-term value. So, when traders look at earnings reports and valuations are always a concern, when we see this deep type of pullback, it kind of changes the sentiment in terms of approach onto these earnings calls, and obviously could have a strong ramification one way or the other based on how the company reports.
Yeah, it's interesting because even with the Morgan Stanley downgrade, I'm actually just seeing JP Morgan has raised the price target here on Dell and talking about how they do expect near-term revenue and earnings upsides from AI leverage companies to reassure investors. So they're looking at a price target of $170, and we're at 124 and change right now. So it's a bit mixed as far as what the analysts think. Hey, Charles, just want to get your overall thoughts on the markets today. We're looking pretty range-bound ahead as what is going to be a pretty busy week. A lot of sort of event risk on the horizon and plenty of catalysts to work with. What are you watching?
NVIDIA. I think a lot of this is going to be tied to NVIDIA's earnings report because, it's not so much that we've heard the pop in the markets, but we have seen some really big unwinding of these AI growth names, and the AI play is really getting pummeled. These Mag 7 names, especially those with, CapEx expenditures towards AI, are getting hit really hard. Meta's barely been able to lift. Microsoft's held up pretty well, and Google's been a strong performer today as well. But, I think a lot of this is highly dependent on NVIDIA, seeing how the semis have performed. We've seen a lot of the growth AI names getting hit really hard. So, this has been kind of the Pied Piper for the markets since we rallied off the lows. I think that, a lot of the market direction and sentiment leading into the December FOMC meeting is going to be really just on the heels of what NVIDIA does in terms of performance on their earnings report.
Okay, I'm just imagining Jensen Huang with his leather jacket now playing some sort of flute or something like the Pied Piper. But thank you so much for putting that in my head, Charles. All right, always a pleasure talking to you. Charles Moon, their stock strategist, Prosper Trading Academy.